So how in the world can missiles flying on a Saturday cause a complete meltdown in a digital market? In this explainer, we're going to break down that surprising and pretty explosive link between a sudden geopolitical crisis and the world of cryptocurrency.
$36.9 million? Just let that number sink in. In only 24 hours, that's how much money vanished from the accounts of some traders. It's a staggering loss, and it was all triggered by one single unexpected event.
But here's the thing. This wasn't your typical stock market dip. This colossal sum was lost by people who made a very, very specific bet. They bet that the price of oil was going to go down. And boy, were they wrong. Spectacularly wrong.
Which, of course, leads us to the big question. How did a regional conflict, kicking off while most traditional markets were completely asleep for the weekend, trigger such a massive shockwave in the crypto world? Well, let's find out.
Okay, let's dive right in. To really understand this loss, we've got to start with the digital trading floor where it all went down. Right, so this wasn't Wall Street or the New York Stock Exchange. The venue was a crypto platform called Hyperliquid. It lets people trade what are called tokenized oil contracts, which are basically digital tokens that track the real-world price of oil. And that loss, just under $37 million, was one of the biggest liquidation events the platform had ever seen for one single asset. Just ouch.
So what could possibly cause this kind of digital carnage? To get the full picture, we have to rewind to the geopolitical trigger, a super fast escalation that happened entirely over one weekend.
Things just went from bad to catastrophic and fast. I mean, it started with leadership changes and some retaliatory strikes, but it spiraled quick. Before you knew it, missiles were hitting critical energy infrastructure in Saudi Arabia and Bahrain, and then bam! Oil output from major producers just plummeted as tanker traffic in the region pretty much ground to a halt. All of this happened in the span of about 48 hours. Just crazy. All right, so you've got this geopolitical chaos brewing. Now let's see how that slammed directly into the digital finance world and created an absolute perfect storm for disaster.
With the Middle East's oil supply suddenly looking shaky, the price of crude oil didn't just go up a little, it exploded. We're talking a 30% surge in almost no time. That's nearly unheard of, one of the biggest single price jumps in the history of the oil market. If you were someone betting against oil, well, this was your absolute worst nightmare.
So what does it actually mean to bet against oil? Well, in the world of finance, it's called taking a short position. The easiest way to think about it is like betting your friend that your favorite sports team is going to lose. You're actively betting that the price will drop. So if it goes up instead, especially by a lot, you start losing money really, really fast. And when those losses get way too big, something called liquidation kicks in. Basically, it's a forced end to your bet. The exchange itself steps in and just automatically sells your position to cover your debts before they get even worse. It is, for all intents and purposes, game over. Your entire position gets wiped out.
Now, this slide here tells the whole story. Look at the sheer imbalance. Almost $37 million in short positions. People betting the price would fall were liquidated, just gone. Now compare that to only about $3 million in long positions. This chart shows a complete and total obliteration of anyone who bet on a calm, quiet weekend.
But here's where it gets even crazier. The damage didn't just stop with those oil contracts. The fear and the uncertainty created what we call a risk-off mood. That just means investors started dumping anything they thought was risky. And of course, that meant a huge sell-off across the entire crypto market. And you can really see the scale of that contagion right here. We're talking over $364 million in liquidations across all cryptocurrencies. Bitcoin alone saw over $156 million in losses. So that weekend war didn't just burn a few oil traders. It lit a fire that spread across the whole digital asset landscape.
This all brings up a really important question, doesn't it? Why on earth were people making these massive, high-stakes bets on oil using a crypto platform in the first place?
Well, the answer comes down to one simple but absolutely crucial difference: time. Traditional markets, they're open 9 to 5, Monday to Friday. They close on weekends. But global conflicts? Breaking news? Yeah, they don't exactly stick to a 9 to 5 schedule. Crypto markets, on the other hand, never, ever close.
And that's the appeal. These platforms offer a serious edge. They give traders the ability to react to breaking news the second it happens. So when missiles are heading towards oil fields on a Saturday night, a crypto platform is one of the only places in the world where you can instantly act on that information and bet on how it's going to affect the price of oil.
So this single chaotic weekend does a lot more than just explain a $37 million loss. What it really does is reveal a new and, potentially much more volatile reality for global finance.
35%. That's a number that should probably get your attention. It's not a market return, it's a forecast. And frankly, it's a pretty worrying one.
This is the new probability of a major U.S. stock market crash, and it's coming from a veteran market strategist named Ed Yardeni. He's raising the alarm precisely because of the kind of instability we just saw play out over a single weekend.
And his reasoning is pretty direct. With oil prices surging past $100 a barrel and these geopolitical conflicts getting wider, the very foundations of the broader market are starting to look, well, pretty shaky. The same forces that absolutely crushed those crypto traders are now putting Wall Street on high alert.
And that really leaves us with one last big question. Are these always-on crypto markets, the ones that react instantly to global chaos, becoming our new early warning system? Are they the canary in the global coal mine, signaling danger to the rest of the financial world long before that opening bell even rings on Monday morning? Something to think about.